Hello, in today's video I'll show you how to use the stock screener to find typical growth stocks. On the website there is an article available where you can read further information. Go to the documentation center and select trading strategies. Here you can find the article which explains what exactly growth stocks are, what you should pay attention to when selecting them, and what the advantages and disadvantages are. In this video we take a look at two different ways to filter stocks that meet the typical fundamental growth characteristics. Welcome to ChartMill. A first important measure for identifying growth companies is by looking at their revenue growth. ChartMill has quite a few filter options for this parameter. In the stock screener, select the tab Fundamental, and for the revenue growth component you can go back up to 5 years and you can equally filter based on the outlook for the next 5 years. The last tab allows you to compare growth on a quarterly basis. It is important that there is steady revenue growth over several years. Faster is better, but don't be blinded by the sometimes unbelievable growth rates that a company can present at the beginning. Such a pace that sometimes exceeds 100% may be impressive, but it is impossible to sustain over the longer term. So focus on continuous growth rather than the growth rate and eliminate companies that show very irregular or even slower growth. An annual growth of at least 20 to 30% for both the past and coming years is a good starting point for typical growth companies. Ultimately, the goal is for companies to make a profit, but with growth stocks this criterion requires some nuance. Investors in growth stocks are mainly looking for companies that are still at the beginning of their success and thus on their way to profitability. Profit is therefore not yet a necessary condition. Companies whose net losses are structurally decreasing while revenues continue to grow are certainly worthy candidates for the growth investor. As with revenue growth, there is a full line for filtering earnings per share growth component. So you can filter by past performance, but equally by expected results up to and including the next 5 years. Again, growth is especially important here. In the book How to Make Money in Stocks, William O'Neill wrote that strong earnings growth is essential to a stock's success and has the greatest impact on its future price performance. Stocks with EPS growth of at least 25% compared with year-ago levels suggest a company has products or services in strong demand. It's even better if the EPS growth has been accelerating in recent quarters and years. Don't be too strict though with the filter settings in the beginning. The idea is to get a broad base list where you can then fine-tune further. The market capitalization of the company is another filter that can be included in a selection of growth stocks. This filter can be found under the General tab, where you can also set a number of other basic filters related to region, minimum price, minimum volume, etc. Now, it would be unwise to simply exclude companies on the basis of their allegedly too high market capitalization. But it remains a logical reasoning that companies with a rather limited market capitalization have more growth potential than the large established values. Trees don't grow to the sky. In many cases you will also find that sufficiently large companies will pay out dividends rather than invest in further growth. In this video I use the example that the market capitalization of the selected companies should not exceed 10 billion, which roughly corresponds to medium-sized companies. But as you can see, there are many other options you can explore. This ratio is used to determine the extent to which the company uses equity or incurs debt to finance its activities. It is not illogical that startup growth companies finance themselves partly through debt, but it is important that this does not happen excessively. This filter is again found under the Fundamental tab. As an example, I select the value 2. A debt-to-equity ratio of 2 indicates that the company derives 2/3 of its capital financing from debt and 1/3 from shareholder equity, so it borrows twice as much funding as it owns. Also keep in mind that this ratio is very much dependent on the sector in which the company operates. Some sectors are more capital intensive than others. The general consensus is that a ratio between 1 and 1.5 is considered normal, with 2 being just about the maximum acceptable. For some very specific capital-intensive industries, that figure is even higher. Therefore, as a general filter, this should certainly not be set too strictly. Rather, after the initial basic selection, you should further fine-tune this filter based on the stocks within the same sector and market. Once you have found companies with more than decent sales and earnings growth and an acceptable debt ratio, it is important not to overpay for such a growth stock. Be aware that you are not the only one looking for such opportunities, and as with any other product, there is a relationship between demand and price. It is quite normal with growth stocks that you pay a premium. However, this does not mean that you have to pay the highest price. Two ratios that can help you avoid overpriced stocks are the price earnings and price sales ratio of a stock. An acceptable price earnings and price sales combined with expected attractive sales and earnings growth are good catalysts for avoiding overpriced stocks. The problem with growth stocks, however, is that it is very difficult to simply set a maximum value for both these ratios. If you do so, you will filter out a number of stocks with strong potential, and this is something we want to avoid at all costs. For example, a value investor will ignore all stocks with a price-earnings ratio greater than 20 anyway. But in that way, you would never have found a stock like Google that quoted in September 2004 at a price-earnings ratio of no less than 133 and a price of about 113. And look where the stock price is now. For these ratios, we will therefore not enter a maximum filter value. We will, however, include both ratios in an overview table that allow us to compare the values with other shares from the same sector. So far, we have manually set the filters to become a selection of growth stocks. However, there is also a possibility to obtain a basic selection using the ChartMill Fundamental Rating filters. These can be found in the Fundamentals menu, more specifically on the first line. There is an overall fundamental rating available, but you can also filter on specific fundamental characteristics, subdivided into a health, growth, valuation, dividend and profitability rating. If you mainly want shares with strong growth features, you can use the ChartMill Growth rating. So if I change this rating to 8 out of 10, only 1,250 shares remain from the almost 22,000 shares in our database. If I choose only US stocks, the number drops to just over 800. These predefined filters are an alternative to quickly obtain a broad basic selection of potential candidates. In this document on the website, you can find some more information about these predefined ChartMill fundamental filters. A direct link to the document can be found in the description below. To view the results, there are several options. For most users, the default view is set to charts. Click in the blue bar on the right next to charts per line and change the value to 4. Make sure that big charts is not checked. If desired, you can collapse the main menu by clicking once on the 3 dashes in the top left. Which settings to use depends largely on your own screen settings. To compare the results based on the selected fundamental filters, you are better off using a table view. If you click on the blue inverted triangle, you will get a drop-down menu where you can select the different views. There are several table views available, but in this case we are going to create a custom table view that displays all the selected filters neatly side by side. Therefore, select Create Custom View, then click on Table View. Click successfully on Ticker, Name and GIGS Sector. These will now appear in the right-hand column. Now change the menu to Fundamental Growth. This is where we're going to select both the revenue growth filters and the earnings per share filters that we just retained in the stock screener. For the revenue growth, it was the revenue growth over the past 3 years, the next 3 years, and the revenue growth quarter to quarter. And then we do the same for earnings per share. So earnings per share growth over the past year, for the next year, and quarter to quarter. Finally, we also include the price to earnings and price to sales ratios. To do this, we switch to the Fundamental Valuation section and select both the ratios. And once you have finished, give this table view a name and press Save View. After refreshing the page, you can now select this table view from the menu and you will get a customized overview of all the stocks based on the filters you just configured. Comparing stocks from the same sector has now become very easy. Go to the General tab and select the sector of which you want to compare the shares. As an example, I will use the sector Healthcare. The results will now only show the list of stocks belonging to this sector. By clicking on one of the different columns at the top, all shares will be ranked from high to low or vice versa for that specific parameter. For example, if I want to see which shares from the healthcare sector have had the highest revenue growth over the past 3 years, I click once on the column heading Revenue Growth 3 years and all the shares are ranked accordingly. If I click again, you will be shown the results from low to high. Investing in the right growth stocks can be enormously lucrative. There are plenty of examples that have shown what phenomenal returns are possible by investing early on in such stocks and giving them every opportunity to develop into the mega companies they have now become. A successful investment in growth stocks could be defined as stocks that you bought a long time ago because of the growth potential, but which have since become so big that now, with the same stocks in your portfolio, you have become more of a value investor. So if you like this video, please give us a thumbs up and subscribe to the channel. And don't forget to hit the notification bell so you don't miss any new videos. Thanks for watching. Bye for now.